So is algorithmic trading right for you? This is a question I get asked all the time, and after helping hundreds of people get connected to automated trading systems, I can confidently give you the answer. And by the end of this video, you'll know if automated trading systems are something that you should dive into or stay far away from, and understand all of the key considerations in between. So let's jump right into it and let's talk about exactly how to go into this the right way, knowing if this is something that you should do or avoid. So the first thing is managing your expectations and defining your expectations, right? So a lot of people think that an algorithmic trading system is a magic bullet. They think because you have a computer executing trades that it should never be wrong, especially in the age of AI, right? Why should you be wrong if AI knows everything? And that simply just isn't the case. So I couldn't even stress how far away that is from the truth. Algorithmic trading systems lose trades all the time. In fact, a lot of incredible algorithmic trading systems lose more than they win. And the reason that's able to work is because they make more when they're right than they do when they lose. Now, that's going to be a very, very important thing to consider, right? Are you okay with being wrong? And are you okay with being right massively when you are right? Because that's going to really define what type of system you should be going into. Aside from that, it's also going to realize what your risk to return gauge is going to be. Now, when I say risk return gauge, basically what I mean is how much risk are you willing to accept in order for a specific return? So if you're going to target 30% a year, how much downside volatility are you comfortable with before you feel like you made a mistake, right? So are you willing to, chase a 30% return in exchange for taking on maybe 15% drawdown in your portfolio? If so, then that's pretty realistic. If you want 10% a month every single month and you're only willing to have a 10% drawdown in your portfolio, then you're completely in outer space and not realistic at all. So those are the things that I would really say. And when I say the term drawdown, basically what I mean is the fluctuation from the highest point of a portfolio, basically pulling back before going back up. So let's say you have a $100,000 portfolio, it drops down to $90,000 and then it goes back to $100,001. That is a 10% drawdown. Okay, so first of all, understanding what drawdown is pretty important, but understanding the type of volatility that you're willing to accept in order for a specific amount of return is incredibly important and probably the first thing that you should define. Now, if you are chasing triple-digit returns, I will say that you are going to have a hard time finding a legit and credible and actual sustainable solution, right? Maybe you could find a system that does it, for a year, but doing that repeatedly year over year over year is quite challenging. Now, not only that, getting triple digit returns is only half the battle. It's how much volatility are you willing to exchange for such return, right? Because you could have a system that, let's say at its normal settings, makes 30% on average for the last, n number of years with a max drawdown of 15%. And you could simply just turn the sizing up. You could trade it 3 times, with as much size. And now you're basically getting 90% a year on average, but now you have a 45% drawdown. So it really all comes down to a give and take, right? How much are you willing to take on from a volatility or drawdown standpoint in exchange for X number of return? Now, that is going to be the first thing you need to define. I would say if you are between the 30 to 60% target side, you are within the realm of reason. 60% is definitely aggressive. We have a bunch of systems in Algo Exchange that have well beyond that, but it's one of those things that doesn't happen every single year, and you need to be okay with the variance, right? So acknowledging that those types of returns are aggressive but possible is very important, but also being realistic from a drawdown perspective is incredibly important as well. Now, the cool thing about, returns and drawdowns is that you can definitely diversify away some of your risk and still maintain aggressive levels of return, but that is a very, very in-depth topic that we could talk about at another time, right? So the first thing is understanding what the proper expectation is. Anything between 30 to 60% a year, I would say is realistic. 60 is definitely on the aggressive side. It's not one of those things that you should say, if it doesn't do 60% a year, it's trash, because that just isn't the case. There's tons of great systems out there that could be sub 40% a year, sub 30% a year. And it's really all about when do they perform, right? Because if you have a system that's up 30% while the overall markets are down 20%, for the same year, and that's awesome, right? It's a good hedge. So you really need to understand what purpose it serves. And that leads me to the next point, is what purpose does algorithmic trading serve in your portfolio? Because algorithmic trading should never, ever, ever, ever make up your entire portfolio, okay? It should be a small piece of your overall portfolio. It serves a purpose because it is a high-risk alternative investment. Algorithmic trading is active trading. Not only active trading, but typically trading leverage products, specifically futures. Trading futures is a great way to extract financial gain from the market, but there's also a significant opportunity for loss. And it's one of those things where you need to accept the fact that algorithmic trading is definitely a worthy thing to pursue. However, there is an elevated amount of risk compared to just investing in ETFs. You know what I mean? It's definitely not the same thing. So understanding that it is a more high risk alternative investment is incredibly important, and it should make up a piece of your overall portfolio. So it should never make up your entire portfolio. I would say, allocate 20-30% of your overall investable assets into it, and that would be, something that you could live with, right? And not only that, but then once you're doing that, diversify that allocation across, 2, 3, 4, 5, 6, 7 different trading systems, and now you're in a much better spot compared to if you just take all of your risk capital and put it in one system. I would never, ever, ever suggest anybody take all of their risk capital and put it in one trading system. Definitely diversify it. That is incredibly important. So number one, make sure you know what your expectations are, and obviously realize that, you're not always going to be in the clouds when it comes to returns. You're not always going to be doing 100% a year, and that's okay. But also acknowledge the fact that you will need to take on an element of volatility and reasonable amounts of drawdown if you want higher amounts of return, right? If you want lower amounts of return, like, so let's say 20% a year, then you could obviously get away with achieving something like that with significantly lower drawdowns than you would if a system was averaging, let's say 40 to 60% a year. So it's all relative, right? So keep that in mind. Second is obviously going to make sure that you understand that this is a more high risk alternative investment. So definitely don't put all your eggs in one basket here, and understand the nature of this type of trading vehicle. Now, the other thing is going to be the trading style, right? A lot of people think all trading algorithms are high frequency trading systems. They're placing thousands of trades a day, and that simply just is not the case either. In fact, most retail trading systems are not high frequency whatsoever. They probably only take maybe, let's say 10, 20 trades a month. There's even systems that we have on Algo Exchange, great systems that perform very, very well, that might even just take 3 to 5 trades a month and could be swing trading systems. So incredibly important to understand that just because it's an automated algorithmic trading system, it is not a high frequency trading system, right? There's probably some high frequency systems out there you might be able to get your hands on as a retail guy, but good luck. I mean, they're typically very resource intensive. You need access to very significant amounts of technology to successfully deploy high frequency trading systems. And quite frankly, you just don't need it from a retail level. From a retail level, you can get away with some phenomenal intraday trading systems that maybe take, a couple trades a day, if that. And there's also some incredible swing trading systems out there. So just understanding that not all trading algorithms are super high frequency. Some incredible trading systems might only take a couple trades a day, maybe even, less than a dozen a month. So really just understanding that because it's an algorithmic trading system, it's not going to be taking tons of trades a day. And quite frankly, that shouldn't necessarily be something that is like a do or die for a lot of you guys when you're considering adding this stuff to your portfolio anyways. But it is also incredibly important to know what type of trading system you're deploying. Is it a swing trading system? Because swing trading systems carry their own level of risk, such as overnight risk. Day trading systems, they don't have overnight risk. So those are things to also be aware of, right? So I would say really the best way to go about that is diversifying across swing trading systems and day trading systems. Just diversifying across more than one is always a good rule of thumb, all right? So understanding the type of trading system is super important. Understanding what type of risk and return you're willing to take on is incredibly important. And then obviously not over allocating is incredibly important. Now, aside from that, it's what is the overall goal here, right? Now, leaving numbers out of it, it's about the actual performance aspect itself in terms of the purpose that it's serving. Are you looking to hedge your overall long-term portfolio? Are you looking for monthly income? Are you looking just to beat the market on an annualized basis? These are all incredibly important questions that you need to answer for yourself before you ever deploy an algorithmic trading system, because how you approach this is going to mentally frame your expectation, and not only that, but shape part of your journey. I truthfully do not believe that you should go into algorithmic trading looking for some type of monthly income. There's going to be variance with trading systems. You can have a system that performs phenomenal for a handful of years and then has an off year. And if you're counting on that one system to basically provide you monthly income, you're not going to be a very happy guy. So don't do that, because in the end of the day, markets, they're changing every single day. They're always different. Now, trading systems are always built on large sets of data, ideally, and typically they go through significant robustness testing and stress testing, but there's always the chance for variance. Okay, so going into it for monthly income is definitely not the right approach, in my opinion. If it is consistently profitable month over month over month, then that's great. And again, there are ways to get there, right? Through diversification, by trading multiple different strategies, you definitely increase your odds of having a smoother experience and a smoother equity curve, right? So the more systems that you're running, obviously your increased chance for stability definitely goes up, assuming that there's low correlations between those systems, okay? So going into it with the idea of a fixed monthly income idea is just not right. right? And I hear it all the time from people. There's a lot of people in the space that sell, algorithmic trading software and pitch it as a fixed income product. And I think that is so unethical and so wrong because it just simply isn't true, especially if you're only offering, 1 to 2 systems. It's certainly not appropriate to go into it with that mindset. So if you go into it with the idea of, hey, I want something that is a little bit more supercharged compared to, the typical names that you're investing in the equities market, then I definitely think that is a good approach. If you're looking for something to beat the overall index, looking for something that is going to give you cash on cash returns, for day trading systems, you're going to be sitting in cash at the end of the day. You don't have overnight risk. It's literally just cash on cash return. You start with one balance at the start of the day, you end with a balance at the end of the day, you made more money, right? You're not sitting in a position the whole time. So that is certainly a good way to go about it. If you're saying, hey, I just want something that's going to give me a better return than, index funds or equities that I have in my long-term portfolio, and not only that, but maintaining the liquidity side of it through active trading, then I certainly think that is the right approach here for most people. Now, that is going to be one of those things that certainly depends on, the individual and what you're looking to get out of it. But I do think that going into algorithmic trading with the sense of, hey, I'm going to be active trading flat at the end of the day, and I'm expecting to beat the market by the end of the year, that's a pretty realistic expectation. And again, it all comes down to how you allocate, because if you put everything in one system and that system has a crappy year, well, then you're not going to have very good results. But if you diversify across a couple uncorrelated systems, your chances certainly go up, and you're probably going to be significantly happier than somebody that's just tying their entire journey and their entire results to one particular system. Okay, so going into it with the idea of having an active trading element into a portfolio that provides more aggressive returns than the overall indices and maybe whatever else is in your long-term portfolio, I think that's a sound approach. So yeah, that's definitely part of it. And yeah, for the most part, these are the key points to consider, right? It's, your risk profile, the type of trading style that you're going to be getting into, how you're allocating, and then what your overall expectation is for the return, right? So depending on algorithmic trading systems for monthly income, as someone that's just hooking something up to your portfolio, I don't really think that's the best approach. Now, if you are a trader looking to get into algorithmic trading and you're looking to build your own systems and you are a full-time trader, then yeah, I think it's realistic that you could figure out a way to do that to where you can be consistently profitable month over month. And even if you're not a trader, there's ways to do it. It's all about diversification in the end of the day. Relying on one single strategy to do its job every single month, every single year is just going to be a disappointment in the end of the day. So certainly by diversifying across multiple different trading systems is incredibly important. Any good trader out there has multiple setups in their playbook. And from an algorithmic trading standpoint, your multiple setups in your playbook equal multiple strategies that you're trading. That's quite literally the exact comparison. So maybe you use 3 to 4 different trading systems, just as the manual trader has 3 to 4 different setups in their playbook. That's really the way to go about it. Okay, so yeah, those would be the main things. Now, another thing is clarifying what algorithmic trading is and what it isn't, right? A lot of people think algorithmic trading, it has to be this magic thing that never loses money ever because it's a computer program that can read every single piece of data in the market and make decisions every 2 seconds or every nanosecond. And that just isn't the case. All it is, it's an automated computer system. You're literally just running it, you're feeding it financial market data, and it is going to execute whenever its rules are met. That's all it is. In fact, most of the best trading systems that I've ever seen actually have the lowest win rates, which is pretty surprising. Most people think you need to have 80, 90+% win rates to have a successful trading system, and it couldn't be further from the truth. I have seen, and not only seen, but we run some incredibly profitable trading systems on Algo Exchange that have 30 to 40% win rates. So you definitely don't need to have a super high win rate, and you're definitely not going to be right all the time. It's really all about how much money you make when you're right compared to how much money you lose when you're wrong. That's what it comes down to. So with that being said, you should have some key points here if algorithmic trading is going to be the right fit for you. I certainly think that it does apply and does serve a purpose for most people in their portfolio. It really just comes down to how you approach it. If you want something that, you're going to get maybe 30, 40% a year on with maybe 10 to 20% drawdown, and you just want something that is going to do its thing without you needing to babysit it for maybe 20% of your overall, investable assets and, 20% of your risk capital, then I think it is a worthy, thing to pursue. I think you'll actually have a good experience so long as you could find the right vendor. So if you're looking for a reliable algorithmic trading system vendor, Algo Exchange runs over $70 million of live capital for retail investors. We have a bunch of different trading systems, all with live track records. So feel free to check us out. We got the link down in the description, and we could definitely get you hooked up to systems that have put up some numbers in the past. And that's literally our bread and butter. That's what we do. But we do run into the person that says they want want 10% a month in perpetuity with 10% drawdown, and we tell them, hey man, this isn't for you, because in the end of the day, we don't want anyone ever coming into it with that expectation, and I don't want you guys going into it with that expectation either, whether you come and work with us or you develop your own system or you just work with someone else in the industry, because it's just not the right way to approach it. So algorithmic trading is incredibly powerful. It is an awesome thing to deploy, but you just really need to go into it the right way. Okay, so understand how much risk you're willing to take on for a certain amount of reward, understand how much capital you're going to allocate, understand the nature of the trading systems that you're going to be using, and just understand what the stuff really is, right? There's no magic bullet out there. The closest thing to a magic bullet, in my opinion, is diversification. So take that for what it's worth. I hope this video provided you guys some value. Check the links down in the description to get access to some of the algorithmic trading systems we run on Algo Exchange. And yeah, overall, happy trading, smart investing, and I'll see you guys in the next video.